Hi, game changers. Let's talk about the Wall Street showdown of the decade. George Soros is battling it out with BlackRock's Larry Fink over investing in China. In addition, Ray Dalio thinks China is a place that cannot be neglected. Year to date, these very popular and well-known Chinese ETFs have all been trading down. iShares China ETF is down 11%, Invesco China Technology ETF and Global X China Consumer Discretionary ETF are both down roughly 17%. Invesco Golden Dragon China ETF is down 28%, Crane Shares CSI China Internet ETF is down 36%, and the iShares China A ETF focused on the onshore Chinese market is essentially just flat for the year. What happened? Of course, the Chinese crackdown. These numbers all came after China's crackdown. Some think it's time to buy the dip, but some say it's way too risky due to the VIE structure. In addition, the growth rate won't be like what it was before. But on September 8th, BlackRock, the world's largest asset manager, said its Chinese subsidiary has set up its first mutual fund in the country after raising 6.68 billion yuan from 111,000 Chinese investors. BlackRock and Ray Dalio both say investors should be in China. However, George Soros says BlackRock is making a tragic mistake investing in China. Who do you think is right? Let me briefly introduce these three players. Ray Dalio is the founder of the world's biggest hedge fund firm, Bridgewater Associates, which manages roughly 150 billion. Today, Ray Dalio is a finance legend who's been called the Steve Jobs of investing because of his tough but innovative management style. BlackRock is very well known in the financial world. It controls 9 trillion, making it the largest money manager in the world. It also runs a massive technology platform that oversees at least 21.6 trillion in assets. In addition, it has hired many former government officials into senior roles. Last but not least, George Soros is a legendary hedge fund manager who is widely considered to be one of the most successful investors of all time. Soros managed the Quantum Fund, a fund that achieved an average annual return of 30% from 1970 to 2000. He is believed to be worth more than 8 billion as of 2021 and has donated more than 30 billion to charitable causes. There's no doubt that these three players all have achieved greatness and that they are all amazing. But right now, BlackRock and Ray Dalio think of China as an opportunity, whereas George Soros think it's too risky and investors should not invest in China. Dalio has been bullish on China for some time. In July, he said Beijing's regulatory crackdown on its tech economy shouldn't spook investors, and added that both US and Chinese stocks should be included in one's portfolio. He also told Bloomberg that opportunities in China cannot be neglected. Quote, "It's a part of the world that one can't neglect, and not only because of the opportunities it provides, but you lose the excitement if you're not there." End quote. When asked about his family office's plans, he said, "Our objective is to be there both economically and investment-wise." He also described the swings in Chinese markets as little more than wiggles in late July. And according to South China Morning Post, Bridgewater held depository shares in some 37 Chinese firms with a market value of almost 1.2 billion US dollars. And for that, I think he really believes China has a lot of opportunities and investors should get involved. BlackRock is the world's largest money manager. According to the Wall Street Journal, so far it has raised around 1 billion for a mutual fund for Chinese individuals, and it's the first and only foreign film allowed to do so in China. Besides the mutual fund, there are a series of other investment products for Chinese consumers as well. The BlackRock Investment Institute also advocated investors raise their allocations to China. However, on September 6, 2021, George Soros slammed BlackRock for investing billions of dollars in China. And he says, quote, "It's likely to lose money for BlackRock's clients and more important, will damage the national security interests of the US and other democracies." End quote. George Soros is very well known for supporting liberal causes through his Open Society foundations. He warns it's a serious mistake for banks and other financial institutions to expand their presence in the nation. Some might wonder if George Soros has short positions on Chinese stocks. I personally think it's very unlikely for him to short A-shares. It's possible to short Chinese A-shares, but it is limited and restrictions are in place. The most you could short of one company is less than 100 million. George Soros manages tens of billions, so even if he shorted all the possible shares, it wouldn't matter that much, and no one knows if he has any short positions or not. So now we have Ray Dalio and BlackRock versus George Soros. Who is right and who is wrong? I believe they are all right in some aspects, and it's not just this black and white. And I have some Chinese stock strategies that I think us investors could use to limit losses, but at the same time still have access to Chinese stocks. When you invest in anything, there are two major things we look at: risk and reward. Let's talk about risk first. When you buy any Chinese stocks via almost all US exchanges, you do not own the real shares of the Chinese companies that you invested in. VIE, or Variable Interest Entity, is a structure developed to go around the Chinese law. Basically, this VIE structure is fundamentally illegal, and the law specifically says that any foreign investment is illegal. So, you could lose everything if you invested in these Chinese stocks without any warnings or compensation. And in fact, China has enforced its laws, and investors and shareholders have tried to enforce the contracts in China's court, but failed, of course. The China Cham case and the Giga Media case both ended badly when they tried to enforce the contracts. However, it's very unlikely that China would take such extreme measures to destroy its own offshore companies, but the risk is definitely there. The second thing is the reward. Now, do not expect you will get the same return investing in China like 10 or 20 years ago. It's completely changed. The growth rate will suffer, and I completely agree with that. The reason is Xi Jinping says what he means, and China knows how to stick to a plan. China gave priority to economic growth for most of the past 40 years. Now, Xi is planning to promote social equality or common prosperity. In a major meeting on financial and economic affairs, President Xi described the wider goal of common prosperity as an essential requirement of the socialism. And according to China's state-run Xinhua News Agency and an official report of the meeting, the government needs to, quote, encourage high-income people and enterprises to give back to society more, and to create opportunities for more people to become rich, end quote. So this new policy priority is one of the factors in China's recent crackdowns on big companies and corporations. China is seeking to reduce income gaps and wants to show the world that China's socialism is better than Western's capitalism in caring for its people. In addition, they are limiting the gains of the capitalist class. And President Xi is showing what is about to happen by making an example of a few large companies already. Furthermore, President Xi says China will set up a third stock exchange that focuses on small and medium-sized companies. It's clear that the growth path for big companies in China will be limited, and we as investors should understand that. However, I think some sectors still have good growth in the foreseeable future. I personally think the EV space in China has huge potential. I believe eventually China will address its pollution problems, and when the policies change, it will have a huge impact in its EV sector. And for those who are still bullish on Chinese stocks, you can buy them listed on domestic exchanges instead. Most Chinese stocks in the US, in most cases, are traded as American depository receipts. Those are under the risky VIE structure. To hedge against the risks with the VIE, we can invest into stocks that are listed in Hong Kong, Shanghai, and the Shenzhen exchanges. In Hong Kong, they are known as the H shares, and in Shanghai and Shenzhen, they are known as the A shares. There are some big brokerage firms that allow direct access to foreign markets. Interactive Brokers charges a commission ranging from 0.015% to 0.05% per trade value plus additional fees and clearing costs. Fidelity charges a flat fee of 250 Hong Kong dollars for every order regardless of trade size. Vanguard charges a $50 processing fee, and Charles Schwab users need to open a separate global account, and they charge 250 Hong Kong dollars per order. They can also trade by phone, but the commission is higher. Unfortunately, E-Trade and Robinhood users cannot trade on foreign exchanges. And in addition, if you want to purchase H shares, you will need Hong Kong dollars. Only time will tell who is right. But right now, I don't think BlackRock's investment in China is as horrible as George Soros says. But I have my doubts if the return is going to be as profitable as BlackRock claimed. So, in conclusion, if you buy any Chinese stocks in almost all of the US exchanges as ADRs, they are risky, and you need to know that you can lose everything. And I think growth in these Chinese companies will be lower, but there are some sectors that can still outperform, such as the UV sector. And to be more protected, buy them on Hong Kong, Shanghai, or Shenzhen exchanges via big brokerage firms such as Interactive Brokers, Fidelity, or Vanguard. That's it for the video. If you find this video helpful and entertaining, like and subscribe. This is Grant. Trade and invest responsibly.